Hi there, everyone, and welcome into this week's market update. Don't forget that any advice contained within this presentation is general only, so it isn't tailored to your particular circumstances. You need to decide for yourself what is appropriate to you. All right, another strong day on the market today, guys. Big lift off, and we managed to close slightly higher than the recent highs through here, breaking perhaps maybe a little bit through this downtrend line. Might call that a break. Perhaps at the moment. If it is a break, then this ends up being a higher trough, okay, and we might push back up near this 200-day moving average. Look, time will tell, okay. At this point of time, it's kind of been that one day up, one day down type market. So who knows, right? We might be straight back down to 66 at the moment. Very whippy, a lot of uncertainty out there. I think really what we're driving up on at the moment is the fact that the US is a bit oversold. Seeing a couple of strong days on a few bits of small positive pieces of news, right? But technically for us, look, XJ at the moment trying to break higher. Bit of resistance here at 68.18. If that clears through, then we could get as high as 7,000. Okay, that's really what we're looking at on the upside. To the downside, we keep toying around with 6,600, 6,630, thereabouts. If that clears through, we're back towards 64. So really sort of very, very range-bound market at the moment. All right, so then looking at the S&P 500, it's been stuck sideways really, right? We've been edging between 35.74 and let's call it 38 with a bit of resistance in near 37. 37 was basically challenged last night. The way the futures are looking at the moment, we're going to break through and maybe come back up near 38 or perhaps this downtrend line in blue here that we've got drawn in. I'll just make that a little bit thicker. That's a bit of a tentative downtrend line. You could maybe bring that through here perhaps, but yeah, look, regardless, this is in a downtrend. Not seeing any signs of bottoming out just yet, and we're toying with some pretty key levels. If it breaks through 38, then we might get a nice big rally back up like we did back here. I'm very doubtful of that, but it could happen. Anything could happen. Then on the downside breakout, which I think is inevitable, okay, at this point, I do think we're going to break lower in the next few months on the back of this inflation issue and higher interest rates and a few other things I'll talk about in a moment. But basically, if that clears through, guys, you've got targets back down near 32 to 40 and then 3,000 as that nice round level. Okay, so really a lot of uncertainty out there, guys, at the moment, without a doubt. Short term, I think it'd have to be a little bit bullish for a few days, but ultimately, from what I'm seeing in the bond markets and things like that, the risk is still fairly high out there. So until I start seeing things change, I'm still going to assume that this is just another bear market rally. All right, so what is going on in China, guys, right? So Chinese GDP that was expected to come out, I think it was tomorrow, is being basically cancelled. They're not releasing a GDP reading. Trade balance that was meant to come out yesterday just didn't come out, right? So they've gone a bit quiet on that front. Politically, there's a lot going on over there as Xi Jinping is trying to cement in his future as leader. There's a lot of chatter going on and rumors starting to come out of that they're finished with Hong Kong and they're going to start looking to move towards Taiwan. Who knows? We know there's a bunch of things happening between China and the US at the moment, between semiconductors and chips and things like that. We haven't seen China retaliate yet. Tensions seem to be increasing over there. So let's just see what plays out, guys. But yeah, there's a lot of rumors coming out of China at the moment. Now, we've seen iron ore come off a lot. We did see the past GDP figures come out pretty bad, much worse than expected. Maybe China's trying to hide something. Maybe they're getting ready for something bigger. Really don't know, right? We're all in the dark here, but there's definitely something happening in China, guys, with the fact that they're not releasing data. And I'd be keeping a close eye on that in the coming months and see whether that escalates any further. The other thing on the rumor mill at the moment is that the Fed might be doing some QE, right? Coming in and buy some bonds because of Janet Yellen's comments the other night. So she made comments that the liquidity in the bond market in the US is starting to dry up, and that the Fed should look at doing some bond buying. Look, let's just see what happens right here. I honestly don't think that's going to happen. Okay, we're already starting to see bond yields fall or stay steady. They jumped quite sharply after the CPI reading last week. Okay, US 10 years now trading back to 4%, the highest level since pre GFC. Okay, really at the end of the day, guys, if the bond yields have already found a level of resistance, it means that the market's under control. If the bond market had no liquidity, I think it would be up to about 5% by now, and it would happen very quickly. Okay, so we jumped to 4%, but guess what? The expectations is that rates are going to go to 4%, maybe a little bit more. So I think the comments are pretty crazy, to be honest. Let's just keep an eye on things. The bond market's my barometer for risk at the moment. If those yields are going up, the market's going down. If the yields are going down, the market's going up. So it's a fairly simple equation there, guys. Keep an eye on that US 10 year as your bit of a gauge. And that tells you, if it's up and holding high, means there's high risk. Okay. If it's going down, okay, that means risk is coming off. People are becoming a little bit more optimistic again that interest rates aren't going to keep flying high. So inflation, guys, it's holding high. We saw a higher than expected inflation reading from the US last week. We saw it again from the New Zealand this morning, and we're likely to see it again Wednesday night from Europe. Markets are ignoring this at the moment. Well, at least equities are. Bond markets are reacting. Okay, I think things have eased off a little bit because in the bond space is mainly because of the UK at the moment. So. But look, inflation's holding high. As long as inflation's holding high, I can't see the Fed pivoting anytime soon. Okay, and that's what we're all waiting for here. Because if they keep lifting interest rates the way they are, it's only inevitable that they're going to go into a recession. Okay, so yes, economic data might be holding up okay right now in the US, but hey, that does not mean that's going to be the case next year. And increasingly, people are getting more and more worried about a recession next year. And increasingly, there's a lot of comments coming out saying that equities haven't really priced in a recession next year yet. Okay, so there could be more to come, right? Um, unless the Fed pivots or unless we see inflation start coming down. Okay, they're the two major things. Now, what's really sort of driving markets at the moment, I believe, is strong earnings. Okay, we saw a lot of the US banks beat on earnings expectations. What it's showing us is the increase in interest rates is actually helping the bottom line for some of the banks, especially locally, right? We saw a decent report out of the Bank of Queensland last week, that early last week, which triggered a lot of the buying on our banks. US banks then followed a bit higher after their earnings as well. Look, it's very early in the US earnings season. We haven't really seen a lot of discretionary and tech stocks report yet, so we don't know what we're in for. But so far, the banks have treated us to some strong earnings. It doesn't mean that forward guidance is going to hold high, guys, right? At some point, the market has to start really pricing in, earnings coming down, and future earnings have not done that yet, right? So if we are going to destroy demand, okay, if we not we, but if the Fed's going to destroy demand and stop us from spending, at some point that has to hit the earnings of companies out there. So at this point, it hasn't really. Well, we haven't seen it yet, but like I said, it's very early in the reporting season, right? So let's just see how this plays out. But what we could get is a bit of a sugar hit on the back of some strong earnings, and then the reality check again on the 1st of November, 2nd of November when the Fed meets. Okay, so yeah, all eyes on data. So anything inflation related, anything central bank related, we've got to be looking at very, very closely. And then outside of that, things like GDP or, strength of the US economy, if we start seeing that strength fall dramatically, which means interest rates are finally starting to kick in, well, that could be, that will probably be negative to start off with until the Fed perhaps pivots, or it could be the other way around, that people might react positively to it, expecting the Fed to pivot. But for now, between now and then, I still think equities need to go lower. The Fed's going to keep the fear going, which means the market needs to go lower to destroy that demand, to destroy that inflation. Right, that seems to be the game for now. And until we start seeing a change, everything else is just speculation. Yep. So we might get a few days of speculation here, guys. The way the futures are looking right now, it's gearing up for another positive night in the US. But we are in very whippy, volatile markets right now. So really, guys, I don't say this very often, but anything's on the bloody table, right? Uh, I wouldn't, I wouldn't be sticking to a short-term directional view right now. My longer-term view is probably us going a bit lower. Especially US going a bit lower. But for the short term at the moment, yeah, it's basically a day trading market, guys. You're going to have a couple of strong days, a couple of weak days, and then we just take it as it comes as the news flows, right? All right, so that's where we're at. Crazy times, interesting markets, some good trading actually out there with the volatility, guys, right? So, good thing about volatile markets is that it's great for options trading, okay? Especially coming into the US markets. All right. So, yeah, look, good trading environment, not a great investing environment, but there will be some stocks on sale at the end of all this. And I can tell you, it probably isn't that far away, guys. Okay. Keep some powder dry, get ready to buy and invest and hold long term because the bottom will come, right? Whether it be 1 month, 2 months, or 6 months. I couldn't tell you the time frame exactly until this all plays out. But yeah, there's a lot of really, really good companies at really good prices, guys. Okay. It's just a matter of where is it going to all bottom out. All right. Okay. Leave it there. Thanks for listening into this video today. Take care. Bye for now.